Picture this. It is 2019. You are sitting at your kitchen table, opening your home insurance renewal letter. The number at the bottom is annoying but manageable. You write the check, you move on. Fast forward to today. You open the same kind of letter, same house, same neighborhood, same insurance company, and the number is 40, 50, sometimes 70% higher than it was 5 years ago. You call them, you ask why, and they say something like market conditions, or increased risk exposure, or, and this is a personal favorite, we've had to recalibrate our actuarial models. What does that mean? Nothing. It means nothing to you. It's designed to mean nothing to you. But here's the thing. There is a real explanation, and when you understand it, you don't feel confused anymore. You feel something else entirely. Why this matters right now. Insurance premiums in the United States have been rising at a rate that has no real precedent in modern history. Home insurance, auto insurance, health insurance, renter's insurance. Across the board, Americans paid significantly more in 2024 than they did in 2020, and the increases show no sign of stopping. In some states, Florida, California, Louisiana, Texas, the situation has moved from frustrating to something closer to a quiet financial crisis. Homeowners are being dropped by their insurers entirely. Others are watching their annual premiums surpass their monthly mortgage payments. Major insurance companies have simply stopped writing new policies in entire states. This is not a weather story, although the weather is part of it. This is not an inflation story, although inflation is part of it. This is a story about a system that was built on assumptions that no longer hold. And nobody wants to say that out loud. So, let's say it. How the system actually works. To understand why premiums keep rising, you first have to understand what an insurance company actually is. At its core, an insurance company is a bet. You pay them a small amount every year. They promise you to pay a large amount if something bad happens. They're betting that nothing bad will happen, or at least not to everyone at once. You're betting that it will. Most years, they win. That's the business model. But the way they decide how much to charge you, that's where it gets interesting. Every insurance company employs teams of people called actuaries. These are essentially professional risk calculators. Their job is to look at historical data, how many houses burned down last year, how many cars were totaled, how many people needed surgery, and use that data to predict how much the company will have to pay out in the future. Then they add a margin on top. That margin is the profit. Simple, right? Collect more than you pay out, keep the difference. Been working fine for over a century. Here's the problem. It only works when the past resembles the future. The mechanism that broke. For most of the 20th century, that assumption held. Yes, there were bad years, big hurricanes, floods, wildfires, but they were exceptional. They were outliers. You could absorb a bad year because most years were normal. Something shifted around 2017, and the insurance industry has not recovered since. In 2017, the United States experienced 3 major hurricanes in a single season. Total insured losses were over $100 billion in 1 year. That alone was historic. But then 2018 brought California's Camp Fire, the most destructive wildfire in the state's history. Then 2020 had a record Atlantic hurricane season. Then Winter Storm Uri hit Texas in 2021, a state that was not priced for that kind of event, and caused somewhere between $80 and $120 billion in economic damage. The pattern stopped being a pattern. It became a new normal. And this is where the actuarial model starts to crack, because those models are backward-looking, they are built on historical data, and when the present stops looking like the past, the math stops working. What do you do when your risk models are broken? You reprice, aggressively and fast. The hidden layer, reinsurance. Now here's the part that almost nobody talks about, and this is the mechanism that connects a hurricane in Florida to your car insurance in Ohio. Insurance companies do not hold all of that risk themselves. That would be insane. If a single major hurricane could wipe out your entire reserve fund, you would not be in business very long. So insurance companies buy insurance. It's called reinsurance. They pay a premium to a reinsurance company, firms with names like Munich Re, Swiss Re, Berkshire Hathaway Reinsurance, and those companies absorb a portion of catastrophic losses. Think of it as a backup parachute for the insurance industry. For decades, reinsurance was relatively affordable. The big reinsurers had deep pockets, long time horizons, and a fairly predictable sense of global catastrophe risk. And then the losses started stacking up. Between 2017 and 2023, global insured losses from natural disasters exceeded $300 billion. In 2022 alone, Hurricane Ian caused over $60 billion in insured losses, making it one of the most expensive storms in American history. Reinsurers started pulling back. They started raising their own rates. Some started refusing to cover certain geographies entirely. When reinsurance gets more expensive, insurance companies pass that cost downstream to you. You are, in a very real sense, paying for risks you will never personally face. Your premium in a quiet suburb of Columbus, Ohio, is partially subsidizing the actuarial reality of Miami Beach. You did not agree to this. You were not told. It just showed up in your renewal letter as market conditions. The uncomfortable math. Let's run some numbers, not to make this dry, but because the numbers are genuinely alarming. In 2018, the average American homeowner paid roughly $1,200 a year for home insurance. By 2023, that number had risen to over $2,000 nationally, and in high-risk states, far higher. Florida homeowners are paying an average of over $6,000 per year. That is $500 per month for insurance on top of a mortgage. Auto insurance tells a similar story. The average annual auto premium in the United States crossed the $1,800 threshold in 2023. That is a 40% increase in roughly 3 years. Why did auto insurance spike so dramatically? Supply chain problems drove up the cost of replacement parts after 2020. Used car values went through the roof, which meant total loss payouts got more expensive. Repair shops couldn't find technicians, labor costs climbed, and modern cars, packed with sensors and cameras and driver assistance systems, cost dramatically more to fix than cars from 10 years ago. A minor fender bender that used to cost $800 to repair now costs $3,000 or $4,000. That is not an exaggeration. It is a line item in your insurance company's quarterly report. They are paying more, so you are paying more. Here is the part they are not telling you. Because the rising cost story, the climate argument, the supply chain argument, the labor cost argument is real. All of that is genuinely happening, but it is also a very convenient frame, because insurance companies have also been extraordinarily profitable. From 2012 to 2020, the property and casualty insurance industry generated consistent underwriting profits and investment returns that made it one of the most stable sectors in the American economy. Insurance companies collect your premiums. Then they invest those premiums in bonds, equities, real estate. The float,
The money sitting there between when you pay and when they have to pay out is itself a profit center. Even in years with elevated claims, many of these companies have returned strong results to shareholders. So the story is not simply that costs are rising and insurers are struggling. The story is that the risk is real and rising, but the pricing power that comes with that rising risk has also made the industry extremely aggressive about padding margins on the way up. When losses spike, they raise your rates immediately. When losses fall, the rates do not come back down at anything close to the same speed. This is not conspiracy, it's just asymmetry. It's how pricing power works when the product you're selling is legally required in most cases and has no easy substitute.